So in our process, we always have an investment strategy conversation with our clients, which is part of the customization process in determining the overall asset allocation. And we use quality growth companies to make up a foundation of that portfolio for investors that have stock exposure. What is a quality growth company, and why have you chosen that as the foundation for client portfolios?
So quality growth companies comprise the core of our portfolios. Our definition of a quality growth company is a company with great products or services, a leading position in a large addressable market, strong management team, and durable competitive advantages. We have quantitative metrics that help us measure those. So there's some judgment, but also paired with quantitative measurement of financial returns for these companies. We want to own stocks for many years. We view ourselves as owners of companies, not traders of stocks. So why these types of companies? The data is compelling, and our experience is compelling that these are the types of stocks that deliver strong returns over long periods of time. The data is even more compelling if we are able to purchase these companies at an attractive price, and that typically occurs when there's some sort of a dislocation in the market, or a company may disappoint on earnings, or a macro event may occur. So that's when the returns are really compelling. Is we own good companies for a long period of time, but with the opportunity to buy them when they're on sale for a short period of time.
Could you explain the difference between a quality growth stock and an aggressive growth or maybe speculative growth company?
The term that we prefer, or I prefer, is emerging growth. So there's definitely speculative growth, right? But we want to find companies or watch companies that are emerging growth companies, and those that may be emerging to quality growth status. So as I mentioned in the quality growth question, there are metrics to measure a quality growth company. One of my favorites is return on invested capital. Is a company returning a higher level on its invested capital, significantly higher than its cost of capital? Emerging growth company is unlikely to do that. Its earnings are often far off in the future. Returns are very compelling when we could buy an emerging growth company that is graduating or will be graduating to a quality growth company. So there's judgment involved there. There's other metrics we look at: gross margins, rate of growth. Is growth accelerating? Market share. Are they gaining market share in an attractive market? So there's a combination of qualitative and quantitative. And again, the core of the portfolios is quality growth, something that we can measure in data and see that this company is meeting its goals and is compounding returns year after year. But we do own some emerging growth in our core portfolios. And for those clients that it's appropriate, a higher level of risk, will own larger amounts of emerging growth companies in their portfolios, tailored to the client's needs. But it's an area that we watch closely, and the one that is very exciting, and we'd like to add as those companies graduate.